Dear viewers of Mind Academy YouTube channel, welcome for this Get to Give session. We have a very interesting individual, financial enthusiast, Mr. Venkatesh. Welcome to Mind Academy's Get to Give program, sir.
Thank you for your invite, Bala. And I also thank all the Mind Academy viewers also for this opportunity.
Thank you, sir. The pleasure is all ours.
Thank you.
I've been very sincerely following all your posts and articles in Facebook related to finance and the insights into finance from your end. You do an extensive research before putting out anything.
Yeah.
So now let me ask this question to begin with, to keep it in an informal way. In our background, in our ethos, if I have to put forward, getting into market is not something which is something overwhelmingly welcomed in the societal aspect.
Yeah.
Amidst this, what was the driver for you to do this and to come out in this forum, sir?
Basically, I was thinking of about the financial planning of mine, especially after my demise of my father after October 2021. So financially, I got into a lot of troubles and also emotionally as well. So that was the starting point for me. Why I landed up in such a mess in my financial aspects, and I ended up not only me, my whole family landed up in a lot of problems. So that is the first starting point. And then I started to browse and read a lot of things why my financial decisions are like that. So I started with the question why. So why I am like this, and asking repeatedly the question why, and I was able to figure out that my financial planning was not that good. I could literally say it's very bad. And then people also have different views on investing in Indian companies through stock market. So many say in a most funnier way or a negative way, but I see it as a value proposition. That is, if you are investing, if you are buying a stock of any company, and you are not only buying a stock, you are becoming a business partner of the company. So you cannot take away with the profit even one day or even in after 2 or 3 weeks. You need to stay tuned till the business picks up some momentum, and then you need to be along with the journey of that particular company, and then you need to take away whatever you are comfortable with. So that is the only thing. So before I started to read about stock markets and stock. I found that mutual funds are more interesting options because it's a passover vehicle where we can either invest directly in the index given by the government, or through some of the actual active mutual funds where people wanted to invest their money through a team of people on certain companies. So I feel it's run in a most professional way, and that has I thought that it has some value, and we can before I foray into that, I keep on reading a lot of stuff. Such that first let me become confident and put my own money into it, and then rest out of it, then we will share whatever we are experiencing. So I read and there and I put all the things. So whoever wants to invest in Indian companies, either directly through firm of equities or through mutual funds, you should keep in the mind that you are becoming a business partner. You are not merely a stock picker, and whatever the journey the company is enduring, you are also enduring the same. Either it's on a higher side or on a lower side. So it is definitely not a gambling. You have to be skillful enough to pick up the right companies and also the right mutual funds. That need a lot of intensive reading, or you can go through a genuine advisor for that to go through that. I feel what Buffett or many investing legends used to say that a 9 to 5 job will make you to survive. But when the time when you are sleeping, your money should work for you. So I catch that phrase and I started reading. And I'm still keep on learning, and whatever I read, I used to share on the Facebook so that many people may get benefited. So that is how it got started. Though I have maybe I have put it in a little higher end way of the thing what I spoke now. I can put it in a much simpler term with the help of questions.
Great, sir. You have touched upon very personal stuff for me as well. Warren Buffett is someone who even I look up to when it comes to investment options and learning as well. He puts out a very interesting aspect. The risk is not in the market. The risk is in not knowing what is it there. So to address this aspect, and for the benefit of the viewers who have not been into the market aspect, I want you to take them through in a crisper way what will be your look into the difference. Conventionally, maybe 20 years back, I have seen people putting their money in the FD market.
Still it's on the higher side only.
So it's there, but I want you to take you through that, because there is an element which I think as an investor you might be very well aware what is it happening in the FD aspect of it. What was the FD aspect, and what is mutual fund, if you can just put it in a nutshell, and what is stock market, if you can differentiate broadly. Probably the listeners who are not into the market aspect will benefit out of it, sir.
Fixed deposit is primarily you go to a bank or any financing institution and put your money into the bank. For the money what you are putting in that particular bank, it is giving you some interest. The interest is nothing but they are borrowing you at certain cost. Say for example, right now the fixed deposit interest rate is 5%. So they are borrowing your money at 5%, and they are giving you the 5% of the total money what you have invested every month or annually or quarterly. This is simple fixed deposit. But on a larger scale or on a larger picture, you see the Indian inflation is more than 7% as given by the Government of India data, and the wholesale price inflation is more than 14%. Okay. So whatever the money you put into the fixed deposit will not grow in as pace with that of the inflation being given by the economy. And so instead of your money going in one full shot, it will slowly get eroded away if you put your money due to the inflation. Inflation is an indirect tax. Many people will be not aware of that. So you are paying a tax in the form of inflation. So everyone is taking a lot of measures to control that, but some things are beyond always our control. So we cannot move that. And then regarding stock market companies, stock market and the companies there. Example, you take Nifty 50 or next Nifty 50. Nifty 50 is full of companies which are having, which are basically called as large capitalization companies. And we call it as a large cap companies. And next Nifty 50 will have some degree of large cap companies and some degree of mid cap companies. So, if you are, so say somebody want to invest in a company. Say for example, we are more familiar with a company called as banks, like either public sector bank or a private sector bank. So that is the most what I say, like most awareness form for everyone. So the bank, the public sector bank will take you the money and they will lend it to different people. And then the difference between the interest rate what they have given you and the interest rate what they have given to their lenders is the profitability for that particular bank institution. So till date, the person who has borrowed money from the bank is paying his interest rate regularly. You have no problem with the profit of the bank as well as your fixed deposit also. So that is about investing in one particular company, either in a bank company or a telecom sector company or in a mining company or in automobile company. So there are many companies out there. So you are becoming with directly a partner of that business.
Okay.
And direct picking of stocks requires a very deep reading. Even I am not but a deep reader about direct picking of stocks. That you at least everyone should read at least, as Buffett used to say, 30 hours per week if you want to become a direct investor.
Okay.
So 30 hours per week, you take a company what you are familiar with, what business you can understand very easily. You take up the business and you read that and how it has performed over the last 3 years. Last 1 year annual report will not tell you anything about that company. You need to read at least 3 years of report. That will give you a cumulative idea on how that business has moved in. The simplest one of business is bank.
Okay.
Everyone is very familiar with. So this intensive reading of companies and their business and their associated risks and their profit margin. So if you are not familiar with any of these things and you don't have the time, particularly if you don't have the time for all these things, you can choose mutual funds. And in the mutual funds, you have two categories. One is index funds and the other one is active mutual funds. So index funds is a very, like a very simple tool. Okay. You invest 500 rupees in an index, say Nifty 50. All your 500 rupees will go directly into all the 50 stocks present in the Nifty 50 according to the weightage given by the Nifty index.
Okay.
So your money will directly go into that. So if whenever the Nifty 50 rises, your money will rise. Whenever the Nifty 50 will fall down, your money will fall down.
Obviously.
So that is also similar to next Nifty 50 also. So you can directly invest there to have first sense of common grip with sense of investing about the company, and slowly you'll come to know everything. That will be a moderate risk. I can say this is not a higher risk; it's a moderate risk, and that may offer you a moderate return. But still, you want to have a larger side of. Still you need a larger returns. You can choose active mutual funds. So there are many categories of mutual funds where you put money in large cap companies, you have large cap mutual funds. You put your money in mid cap companies, you have mid cap mutual funds. And you put your money in small cap companies, you have small cap mutual funds. And you have flexi cap, which invest across all these things. And if you don't want to take up the risk of being invested in company business, you can put it in debt funds, DEPT, debt funds, where you purchase the bond of any particular company, and depending on the bond interest rate risk and as well as the credit risk, your value may go up or down. So both equity investing as well as debt investing has its own do's and don'ts and also its own risk. So nothing is risk free. Even I can say fixed deposit also has a bigger risk of eroding your capital slowly due to inflation. So this is all about
great, sir.
All the three things.
You have touched up all the three macro stuffs in a very crisper way. Thanks for taking us through that, sir. And you said during your explanation and very interesting element, which is do's and don'ts in the whole process. So discipline and patience. I myself, when doing this investment aspect, get sometimes impulsive, restless, expecting things to happen overnight. As an investor, how critical is to be disciplined and patient during this process? How would you categorize it, sir?
People who have made money in stock markets, either directly from the companies or through mutual funds, 4 elements they should not have before investing into either stock markets or through mutual funds. Ignorance, greed, hope. All the 3 things they should not have. Ignorance, greed, hope. Everyone, all the financial leaders used to say the same thing. So, and then it's the behavior of the investor in the market that will determine your returns, rather than how much I know about the technical things of the market, technical financial background. So you have bought a very good business 4 or 5 stocks, or you have bought very good mutual funds, either on your direct investing knowledge or through a genuine mutual fund advisor. You have bought it. And what you have to do is buy right and sit tight. That's all. There is always noise in the market. There are always speculations going around the market. You cannot do anything about it. Most of things are speculation. You can keep on seeing many news channels on all these things. They will give a lot of commentaries. So ignorance, fear, greed, hope. Sorry, I missed out hope. So only thing which is true in anything, either in business or in anything, is uncertainty. So you should accept the uncertainty. You should realize the uncertainty. Anything might happen at any time. So you are going with the business on the thing that this business has a potential to flourish. Say, for example, electrical vehicles. That is one of the business that might pick up steam in the years to come. So please eliminate ignorance, greed, hope, and then what I told: ignorance, greed, hope,
fear.
Yeah. So eliminate all these 4 and buy the right stocks and sit tight and leave all the noises. Let the business will speak for itself. You don't need to worry about anything. That's how people like Buffett have created so much of wealth. I think Buffett has had a major portion of wealth coming for him after the age of 50. So even he has donated considerably a large sum of money towards charities. Still, he is one of the biggest person in terms of wealth. But what he followed is a very simple behavioral sense, that his conviction about the business what he has bought has fetched him a lot of returns. And we should have that conviction of this business will go on well, despite of the short-term turmoils. Otherwise, every market rise will make you very happy. Every market fall will make you
worried,
so unhappy. So long-term investing is all about 99% behavior and 1% of whatever the knowledge you have on that business.
Great, sir. Ignorance, fear, hope, and the elements which you have greed, and also and very important element which you have put across is buy right and sit tight. I guess the listeners will be making note of that, sir. And before we wrap up this session, one final question to you, sir. If I am listening to you, or if a listener is listening to us today who has no experience in mutual funds or stock, what is the first thing he or she should be doing today, sir?
He should first understand what I told you before, the last the four things: ignorance, greed, hope, and fear. Ignorance, greed, hope, fear. First, he should understand. She should understand it, because otherwise he cannot make even a decent return out of the companies.
How that can be achieved, sir? Any one suggestion?
One suggestion is you start buying the business what you are very familiar with. This is what Buffett is adapting for many years.
Okay.
If you are in a banking system, buy bank. If you are working in an automobile sector, buy an automobile company. But you should not buy at random. You should analyze all the sectors. Fortunately, I think 11 or 18 sectors are there. I don't remember the exact count. Out of any of the sectors will be employed. So many will be employed in IT company.
True.
So there are many stocks in IT company, and you are basically aware of how an IT industry will work and how they are able to generate revenue, and how the revenue is being split in so many forms, like expenses in the form of salary or any other thing. Whatever industry you are there, first of all, you start with the industry. Read about what are the companies in which industry you are in, and then if you are having a deep confidence on this company or this industry will move on well. Suppose somebody is doing a degree in pharmacy, he can start off analyzing all the pharma companies. And if he is a very that spark of conviction, I think we cannot explain that. Okay, fine, we'll go ahead. So you can start with the 500 rupees. Yeah, I am not saying, or I am not urging anyone to buy piles of stock. You buy with one stock, or you start with a simple systematic investment plan, monthly 500 rupees in any active mutual fund or in index fund, whatever of your choice. And then slowly read all the macroeconomic news in all the uh, business portals or in business channels, what is happening in the economy. So that reading should not stop. Having said that, I have made my first degree of reading, and I have bought this stock. I am done with my investing, not at all. You're just at the point, not 1% of the journey of investing. That is not, and you should follow not about that company, about that sector, how it performs, all those stuff. It's a bigger thing. So if you don't have time for that, you go and approach a financial advisor. There are many fee-only advisors present there. And if you go to a mutual fund advisor, he will not charge you any money. Okay. And he will analyze all your risk appetite and risk profiles and what are your financial goals. And there are many genuine people also there. See, so approach those right people and then start gliding with them and follow all the macroeconomic news. That will in turn set your microeconomics of particular industry or the country. So reading is more important. As Buffett says, 330 pages per week, but he himself reads 500 pages per day at the age of 92, I think he's now. Charlie Munger is more than 100, I guess. Both of them reads more than 500 or 600 pages per day. So that reading is a compounding. So that will help you anyway down your life. It's a compounding. Not only your money gets compounded and get you returns. It's your reading habit. And myself, I'm also not a big reader. I am a macro reader, what I can say. 10 power minus 6 or 10 power minus 3. So you should be a nano reader, like 10 power minus 9, not miss even a single pinch of detail. And so I'm just started reading, but I urge everyone to read a lot on whatever you're interested.
Wonderful, Mr. Venkatesh sir, for taking us through that insights about financial aspects as far as investing is concerned in FD, mutual funds and stocks. We all understand this is a very long journey. It's a very vast ocean. It cannot be brainstormed in one day or 1 hour. So we will leave it at here for time being, sir. Probably on another day, on another outset, we'll fall back to understand the detailed options, as you say, the micro aspects of every spectrum. So when things fall back, we'll be looking forward for your support to take our listeners to the next set of journey in this financial.
Yeah, sure. Whatever I read, I will share. That's all.
It's a pleasure having you in. Thanks for your time.
Thank you, Bala, and thank you for all the Mind Academy viewers for giving me this opportunity. Thank you.
Pleasure, sir. So, dear viewers, it was an interesting session out there with Mr. Venkatesh, taking us through the investing options and how you have to prepare yourself. So, remember those 4 elements: fear, greed, ignorance, and hope. And buy right and sit tight. For sure, we'll be heading up in the right direction. Till we fall back for another session for Get to Give, I leave you out there. Right. So have a nice weekend and stay safe. And see you soon.